The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner. I'm here with Jeff Perry and Brian Regan, both of Asset Management Resources. Jeff is with me as my co-host throughout the show. And Brian is our guest for talking about some market activity. We haven't had Brian on in a while. And before we dive into that, I want to just mention a couple of things. One is, if you haven't gone Christmas shopping, you're running out of time.
Literally, you're almost out of time.
So, time to run out there and do your urgent shopping.
I think you're even too late for Amazon at this point.
I think so, probably so, right? But you're not too late for what we're going to be doing over the next few weeks, and that is our regular offer. This time of year, we often will make available to our listeners a portfolio review. And we're going to give away 10 of these this year as well. So we find that it is very common for people to want to focus on their financial life as they start a new year. And so we're coming into the end of the year and wanted to make that offer available to you. And we usually start that very close to the end of the year. So I think we're at that point where if you want to reach out, you can email us by emailing radio@amrfinancial.com, and or you can connect with us by just giving us a call. 508-771-8900 is our phone number. And it's easy just to either leave a message if we're not here, or you're certainly welcome to send us an email as well, or go through our website, amrfinancial.com. You can find it also by going to somethingmorewithchrisboyd.com. And on the website, there's many locations, but you can express an interest in being contacted and just mention the offer. And what this offer is a little bit lengthy. I'll elaborate on it more in future weeks, but we basically will do a detailed analysis of your portfolio. And we think it's important to look at a portfolio in the context of your overall financial planning. So we're going to get an insight into some of the financial planning issues as well. And then we'll do some assessment of what you have and offer you some ideas as to what's working, what might not be working, and how we would do things if we were involved, how we might do it differently. So give you a flavor of some of the things to consider, and entirely up to you what you do with it. It's a no obligation, complimentary review, and I hope you'll take advantage of it. Go to amrfinancial.com and just write, if you want to reach out to us, just write something about the offer in the process, and we'll know what that is. So, all right. With that, let's jump into talking to Brian. Brian, it's been a nice run in the markets of late, and can't help but feel pretty good about that and some of the decisions that you've made in our portfolios. But we also want to talk a little bit about what's coming down the road as we look ahead. So where should we begin?
Well, you're right. I mean, it's been an incredible run here. I'm looking at a chart from October 26th right now. I'm just looking at the major averages. The NASDAQ 100's up 17.5%. The Russell 2000's up 20%. The S&P 500's up almost 14%. International stocks also joining the party, 12%. And bonds have rallied big time. Almost up. The aggregate bond index is up almost 8% since that time. So that's all in under 2 months that we've had that run. So, I'll take it. We talk all the time that markets don't move in a straight line, and it's very difficult to time. But we got a more than a year's worth of returns here in 6 weeks. So happy times, isn't it? I think we should all feel good about that. I know personally I do. And where
Absolutely.
are we going? And where are we going from here? Personally, I feel better about the market than I have in a long time. We talked in our last webinar at the end of October about how the 10-year Treasury was inexplicably high, and we have seen an incredible rally to that point. We were around 5% at that time, which quite frankly left me head scratching. I had a whole segment that I said I was dead wrong, and it looks like the market, has corrected itself, and now say that it was dead wrong, right? Which can happen from time to time. I wrote an article recently about the NASDAQ 100 and how, you could see a peak in a valley over the last 3 years and then another peak, and it couldn't possibly be rational throughout that whole time. There was some irrationality there somewhere. And for us as long-term investors, it's our job to try to take advantage of that, irrationality. And, hopefully some good allocators and some good investors were able to take advantage of that and participate in the incredible rally that the NASDAQ's had this year, up 55% or so, just year to date. So just an incredible run. We're looking at the major averages close or over all-time highs. And I used to say often, I haven't said it in a while when we were at all-time highs, that the glass doesn't get full, the glass gets bigger. All-time highs are not a reason to sell. I think people often say the market's at all-time highs. How much higher can it go? Well, it routinely makes all-time highs. That's how it works. The economy grows, companies grow, they make more earnings, and they participate in the ever-growing production that our global economy has. So, we're at all-time highs. I don't think
the article that you published recently or posted. Tell everyone where they can find that.
Yeah, so I write for the Retirement Daily on thestreet.com. If you want to look at all my articles, you can Google, Brian Regan, The Street, and it will come up, every article I've ever written there. So there's a good little history of some good information.
Yeah, terrific. So check those out. The other thing I wanted to ask you about, as you were describing that, is, does it worry you when valuations get extended? That is to say, we had a nice run. Or do you think that you sounded content that, hey, things are still pretty good? Do you envision the fact that, earnings might just continue to grow and we won't have to worry about the notion that, maybe we've had a good run and valuations can get extended?
Yeah. I mean, I would be concerned if I thought valuations were overly extended. I don't think they are. Yes, I mean, if I thought that the market was overly expensive, then, I absolutely would be concerned. But what we've seen here is this rapid drop in the 10-year. You should see an expansion of PE ratio. So I often, hear people say, the market extended a multiple of, 2x over where it was, 2 months ago. And it's like, well, the 10-year also dropped 1%. And it should, it should reflect a greater PE multiple. All markets trade relative to each other. Now, at the same time, we are expected to have a little bit of a boom here in earnings. So, if you put those lower rates and higher earnings together, the market should be pricing in, higher
improvement. Yeah, that's where I was going. I was expecting to talk about earnings. Yeah, sounds good. So that ultimately can drive things higher. So I was thinking some articles seem to expect sort of a bland year next year until year end, when outcomes of political dynamics will be more known. Talk about this concern that naturally a lot of clients focus on, and I'm sure listeners focus on in the midst of an election year. How does that how can that influence markets, or to what extent should they be looking at this as a driving consideration for their investing behavior?
I don't think they should be thinking about it as a concern for their investing behavior. I think it's a mistake typically to think about politics as a guiding force to your portfolio. Now, insofar as you insist on doing it, election years are typically very good for the stock market. So, we are at a time of year when a lot of people like to write articles on where they think the market's going to go in the next year. And there's usually a range, and people typically think the market's going to progress 8 to 10% a year, in line with the long-term averages. It's interesting, the market almost never goes up 8 to 10% a year. It usually goes up a lot more or a lot less. But typically, the ranges of estimates tend to fall around that mean. I take all that stuff with a grain of salt. What I like to do is look at the market conditions today. Did the prices make sense? Based on what the expectations are. And if the market makes sense, over time you should get that 8 to 10%, reasonably. If the market's cheaper, which happens sometimes, certainly happened with the NASDAQ and at the end of 2022, your forward returns opportunity is going to be greater. And if the market's too expensive, it's going to be lower. That's the way I look at it. There's a lot of behavioral dynamics that could play in. Obviously, there's a lot of unknowns that are going to happen in 2024 that we just can't foresee that could change the market. And generally speaking, when unknowns are taken off the table, like the presidential election, for example, that is good for the market. So, I would be careful about putting too many eggs in your political basket as usual.
Brian, we're talking a lot about the general market. Are there certain sectors that you're more optimistic about or less optimistic about for 2024?
Well, I've been very optimistic about the NASDAQ, in 2023. And that was largely because we were very short in duration. So being short in duration allowed us to take more, take more risk on the equity side of things in case rates had gone down. And I think, if you smooth out some of the wild changes in interest rates, it's been a little more stagnant here in 2023, which has been good for the market. Now, when it comes to the NASDAQ going forward in 2024, if you look at the earnings expectations and what's driving the earnings expectations, it's largely coming from one company, and that's NVIDIA. So the range of possibilities of things that could happen is very wide. I wouldn't be surprised if the NASDAQ had a good year, and I also wouldn't be surprised if it had a bad year. So, that is when the range of expectations is so wide, we call that risk, right? You could, the flip side of risk is luck, right? You could be lucky, or it could be risky if things go down. So, I think we'll be backing off, the gas pedal a little bit there in 2024. At the same time, we've had a really nice run here in high dividend stocks, and I think that's mostly benefited from the change in rates already, and so I think we probably take the gear off that a little bit. Small cap stocks have had an incredible run in the last 6 weeks, but they have been in the basement for a long, long time, and they have not participated. And they've not participated because of the inflationary environment, because of the rapid changes in rates. And as we've seen a stagnation in interest rates going up, we've seen the small caps accelerate. So I think there's a more opportunity in small caps than there are in the larger cap stocks right now. But generally speaking, I'm feeling pretty good about the market, and that's just one guy's opinion. And
Sure.
I can certainly be wrong, and I'm certainly going to adjust that opinion if the facts change.
Any sectors that you're avoiding that you have a negative outlook on for any given reasons?
I think it's hard to have a negative outlook right now. So let's go through some of the sectors. Now, in the technology sector, for example, we talked about NVIDIA. That has earnings expectations that are through the roof. it's hard to be bearish when the expectations are that high. You know,
Do you think that related to the AI kind of becoming the issue right now?
Of course it is. And Microsoft having a relationship with OpenAI, you know, they're going to do their expectations are positive as well. You know, people for good reason always expect Apple to do well. I think it's really the only monopoly that we have in this country. So when you look at the technology sector, it looks really good. When you look at consumer discretionary stocks, which, you know, is about, when you think about goods versus services, goods make up about 2/3 of the S&P 500, and services make up about 1/3. So it's the S&P 500 is more heavily tilted towards the goods sector, which has stagnated since the pandemic because people had the opportunity to build up on their goods during the pandemic. And that's why we saw a little bit of an earnings lull, and that's also why people expect earnings to accelerate forward here going into the future, because the expectation is that we've troughed on our goods. So if you believe that, then consumer discretionary stocks, you know, could also do well. In 2023, if you look at the sectors that haven't done well, you know, I think about utilities.
Mm-hmm.
Now, if utilities should, you know, gain a return on equity around 9%, 9 to 10% every year. Yet their prices are, to me, irrationally volatile. So when you see a big sell-off in something like utilities, oftentimes I think there is an opportunity there. So, you know, when you start to think about what am I negative on, you know, I think it would be more the services sector. So you think airlines, they've been doing very, very well. There's a chance they could continue to do very, very well. But if you expect a transition we had to transition from goods to services, and if you expect the services back to goods, you know, the airlines might suffer a little bit. You know, but that being said, airline manufacturers like Boeing, we've seen run a lot recently, and that's because they've gotten a whole lot of orders, and they're actually executing and not having the operational problems that they've had in the past.
Right.
So, you know, I think as usual, you know, typically there's a lot to be optimistic about. We could certainly get a spike in inflation again. You know, it doesn't seem to be the trend, but I think it's certainly something that you need to keep an eye out for, especially as rates come down and the economy stays strong. It's something that could rear its ugly head again. It's certainly possible. And in that case, you know, you do want to rethink your portfolio as well.
What do you think about healthcare for 2024, the healthcare sector?
I don't know much about healthcare, quite frankly, but you know, these drug companies that are working on these weight loss drugs are having a lot of success. It's undeniable, and you've seen Eli Lilly, for example, have an exceptional 2023 for that reason. You know, Novo Nordisk, I think they're involved with Ozempic, which is the diabetes drug that people are taking to lose weight. You know, they've also done really well, but you know. I look at a company like Pfizer, which
has not done well. Rough year.
The stock hasn't done well. The company is doing fine. So the stock is being hit because they're not selling any COVID-related drugs anymore. This should have been widely expected by investors, and
you would think,
you know, it's getting sold off to me something, you know, very unfairly. This is something that has close to a 7% dividend yield right now. The last time I looked at it, it was fairly safe. You know, last time I looked at it with a fine-tooth comb, it's probably been a minute. So, you know, do your own diligence. But you know, there's certainly places that there's opportunity. We know that Moderna, for example, they have you know, they unlocked a great technology that we all know of. They haven't had a second blockbuster product, but I think they're certainly capable of it. I know that they have lots in the pipeline. So, you know, I'd be very interested in good companies that have shown that they can produce in the past that haven't necessarily done well in 2023.
With a relatively short amount of time still, I'd be interested in just having you talk a little bit about credit and duration and just, you know, fixed income thoughts.
Good questions. We've had you know, credit has had a wonderful couple months. It's had a good year. So, you know, I've been cautious on high yield, especially since the bank problems in March. It hasn't been a bad thing for our portfolio to be cautious about high yield. You know, we've done I'm very happy with how the fixed income portfolio is done this year. And we've emphasized international stocks and really being short on the duration curve. Why take risk when you don't need to, when you're getting paid nicely. I've been cautious on credit. If you think that there's going to be a recession, credit is going to be hurt. So spreads are very tight. People are very optimistic that we're not going to have something like that. I like to get into credit when people are nervous. It's usually you get a lot of nice pricing in those types of situations. So, other types of credit like bank loans are typically floating rate. If we're expecting short-term rates to start to come down, you might not want to be in floating rate. It's less appealing. So
what about with the notion that the Fed is talking about reversing course over the coming year? Does that imply any thoughts about how one should position their duration risk and how they should be positioned on their investment bond portfolio?
Yeah, I know we're running out of time here too. So quickly, don't be too rash in how you maneuver your bond portfolio is my opinion on that. The Federal Reserve tends to change their opinion often and quickly. So
you just saw.
It's got to be rational. Look at the prices. Oftentimes, they've already reflected forward expectations of what the Fed's going to do.
Good point.
Yeah, very good point. Thanks. That's a real good outlook. A little, good sense of what's going on and what to expect as we look ahead. Again, if you need help in thinking about your portfolio, get a portfolio review. Reach out to us at amrfinancial.com. We're happy to talk to you about your needs. Hey, everybody. Thanks for being with us for this segment. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources LLC and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.